Welcome to our latest video where we'll delve into an exciting topic that many investors are wondering about, which is the better ETF to buy, SCHD or JEPQ? That's right. Today we're diving headfirst into the world of exchange-traded funds, or ETFs for short. For those of you who are new to this, ETFs are essentially investment funds and exchange-traded products, the shares of which are traded on a stock exchange. Now, why are we looking at SCHD and JEPQ specifically? Well, these two have been making waves in the investment community, each offering unique advantages and potential drawbacks. It's a hot debate, and we're here to shed some light on it. Over the next 20 minutes, we'll be exploring these two funds in depth, examining their management fees, yields, and overall performance. In the next few minutes, we'll dissect the management fees and yields of both ETFs, so stay tuned. Hello viewers! If you are enjoying this content, and you do not want to miss future videos filled with even more tips, tricks, and inspiration, hit that subscribe button now to stay tuned with us, and remember to comment and share. First, let's take a closer look at SCHD, otherwise known as the Schwab U.S. Dividend Equity ETF. This mouthful of a name represents an exchange-traded fund that focuses on U.S. stocks with a strong track record of paying dividends. Established in the year 2011 by Charles Schwab, SCHD has been a preferred choice for investors who are on the hunt for reliable dividend income. It's crucial to note that this ETF does not just randomly pick any dividend-paying stocks. Instead, it follows a specific strategy, selecting companies that have consistently paid dividends for at least the past 10 years. In essence, the SCHD is a beacon of consistency in the ever-fluctuating world of investments. Let's talk about the management fees. Nobody likes to pay fees, right? Well, SCHD understands this and keeps its expense ratio remarkably low. We're talking about an expense ratio of just 7 basis points. Yes, you heard it right, just 0.07%. This is significantly lower than the average expense ratio of other ETFs in the same category, which typically hover around the 0.3% mark. So, if you're an investor looking to maximize your returns and minimize your costs, SCHD could be a great fit. Now let's shift gears and talk about the current yield. As of today, SCHD offers a yield of around 3%. This yield might not seem astronomical at first glance, but remember, we're talking about a fund that focuses on consistency. And in the realm of consistency, a 3% yield is pretty solid. One of the key features of SCHD is its diversification. It holds a broad basket of around 100 companies, spanning across various sectors. This diversification helps to mitigate risk and provides a level of stability. It's like the old saying goes, don't put all your eggs in one basket. SCHD takes this saying to heart. Another notable benefit of SCHD is its transparency. As an ETF, it provides daily updates on its holdings. This means you can always know exactly where your money is going and how it's being invested. This level of transparency can provide a sense of security and control that you might not find with other investment options. Finally, let's touch on performance. Over the past decade, SCHD has provided investors with steady growth and reliable dividends. It has proven to be a resilient player, even during economic downturns. So if you're an investor who values stability and consistency, SCHD could be a worthy consideration. Now that we've covered SCHD, let's move on to its competitor, JEPQ. Next on our list is JEPQ, or the Jefferies Equity Premium Income ETF. Let's dive right into the basics of JEPQ. It's an exchange-traded fund, or ETF, that is managed by Jefferies. It focuses on generating income through a strategy of writing or selling covered call options on a diversified portfolio of equity securities. This strategy aims to produce a stream of income that is distributed to shareholders on a monthly basis. Now, let's talk about management fees. JEPQ has a management fee of 0.75%. This may seem a little high compared to some other ETFs, but remember, it's not just about the cost, it's about what you get for that cost. And with JEPQ, you're getting a specialized strategy that aims to generate income in a variety of market conditions. Speaking of income, let's discuss yield. The current yield of JEPQ is around 5%. That's right, 5%. This means that for every $100 you invest in JEPQ, you could potentially receive $5 back each year in dividends. This is one of the key features that makes JEPQ an attractive option for investors seeking regular income. But the benefits of JEPQ don't stop at income generation. This ETF also offers diversification, as it holds a variety of equity securities in its portfolio. This can help to spread out risk, which is especially important in uncertain market conditions. Another key feature of JEPQ is its strategy of writing covered call options. This is a more advanced investment strategy that can generate additional income from a stock portfolio. By writing covered call options, JEPQ is able to collect premiums, which are then distributed to shareholders as part of the monthly income. One more thing to note about JEPQ is its transparency. As an ETF, it provides daily portfolio holdings information so you can always see exactly what assets it holds. This helps investors make informed decisions about whether this ETF aligns with their investment goals and risk tolerance. To summarize, JEPQ is a unique investment option that offers a high yield and a specialized strategy for generating income. It has a slightly higher management fee, but this is balanced by the potential for regular income, diversification benefits, and the transparency it offers to investors. With JEPQ covered, it's time to put these two ETFs head-to-head. One of the key factors investors consider when choosing an ETF is the management fee. Let's compare SCHD and JEPQ in this regard. When it comes to ETFs, every little bit counts. Management fees, also known as expense ratios, can take a small but significant slice out of your investment returns over time. Essentially, these fees are the cost you pay for the convenience of having a professional manage and administer the fund on your behalf. Now let's put SCHD and JEPQ under the microscope. The Schwab U.S. Dividend Equity ETF, or SCHD, boasts a low expense ratio of 0.06%. In the world of ETFs, that's considered quite competitive. It's one of the reasons why SCHD has built a reputation as a cost-effective option for investors seeking exposure to U.S. dividend-paying stocks. On the other side of the coin, we have the John Hancock Preferred Income Fund, or JEPQ. This fund has a higher management fee, coming in at 1.02%. That's nearly 17 times the expense ratio of SCHD. This fee difference may seem minuscule when looked at in isolation, but let's consider the impact over time. Imagine you've invested $10,000 in each fund. After 1 year with SCHD, you would have paid approximately $6 in management fees. With JEPQ, that figure jumps to a staggering $102. Now, extrapolate that over a decade or two, and you start to see the long-term effect of these fees on your overall returns. But remember, lower fees don't automatically make one ETF superior to another. There are other factors to consider, such as the fund's performance, its risk profile, and its yield. As we've seen, management fees can significantly influence your investment's growth. But how about yields? Yield is another critical factor that can sway an investor's decision. Let's take a look at how SCHD and JEPQ stack up. When it comes to yield, SCHD has consistently delivered a strong performance. This ETF is known for its focus on high dividend-yielding U.S. stocks, which has led to a relatively high yield over the years. The past year, for instance, saw SCHD delivering a yield of around 3.5%. This is considerably higher than the yield of many other ETFs and can be a powerful draw for investors seeking a steady stream of income. On the other hand, we have JEPQ. This ETF takes a different approach, focusing on equity securities of companies across the globe, excluding the United States. Due to its international focus, JEPQ's yield can be more volatile, reflecting the economic conditions of the countries it invests in. Over the past year, JEPQ's yield fluctuated around 2.5%. While this is lower than SCHD, it's worth noting that JEPQ provides exposure to international markets, which can offer diversification benefits. What does this mean for potential investors? Well, if you're an income-focused investor, SCHD's higher yield might be more appealing. It provides a steady income stream, which is particularly attractive in an environment of low interest rates. However, if you're looking for diversification and are comfortable with a bit of volatility, JEPQ might be a better fit. Its yield may be lower, but the exposure to international markets can offer potential growth opportunities that you might not get with a US-focused ETF like SCHD. Remember though, that yield is just one factor to consider when choosing an ETF. It's also essential to think about your risk tolerance, investment goals, and the overall fit with your portfolio. Yields can indeed make a significant difference. But is there a clear winner between SCHD and JEPQ? Having compared the management fees and yields of SCHD and JEPQ, it's time to draw some conclusions. Let's take a moment to revisit the main points from the previous scenes. The SCHD, or Schwab U.S. Dividend Equity ETF, is a fund that primarily targets high dividend-yielding U.S. companies. It has a low management fee of only 7 basis points, which is considered quite attractive in the ETF universe. On the other hand, its yield has been fairly stable over the years, providing a steady income stream for investors. Moving on to the JEPQ, or the Jefferies Equity Premium Income ETF. This fund employs a different strategy aiming to provide income through selling options on equities in the S&P 500. It has a higher management fee of 75 basis points, but it also offers a higher yield, which could be attractive to those seeking more immediate income. So how do these two ETFs stack up against each other? It's not a straightforward answer, given the different strategies and focus of each fund. SCHD, with its focus on high dividend-yielding companies and lower management fee, could be an attractive option for long-term investors who are looking for a steady income stream and want to keep their expenses low. It's a more traditional approach to income investing, targeting companies that have a history of paying out high dividends. JEPQ, on the other hand, with its higher yield and option selling strategy, could be appealing to investors seeking higher income in the short term despite the higher management fee. This strategy involves more risk, as the income from option selling can fluctuate based on market conditions. However, the potential for higher income may be worth it for some investors. It's also worth noting that the risk profiles of these two ETFs are different. SCHD, by investing in dividend-yielding stocks, exposes investors to the potential volatility of the stock market. JEPQ, while it also has exposure to the stock market, has additional risk from the option selling strategy, which can be influenced by a variety of factors such as volatility levels and the price of the underlying stocks. So which is the better ETF to buy? It really depends on your individual investment goals and risk tolerance. If you are a long-term investor looking for a steady income stream with lower fees, SCHD could be a good fit. If you are willing to take on more risk for potentially higher income and are comfortable with the higher management fee, JEPQ could be the better choice. But remember, investing is not a one-size-fits-all endeavor. It's important to consider your own financial situation, investment goals, and risk tolerance when deciding which ETF to invest in. It's also crucial to do your own research and possibly seek advice from a financial advisor to ensure that your investment decisions align with your financial goals. In conclusion, both SCHD and JEPQ have their own unique strategies and offerings that can cater to different types of investors. They both have their own merits and potential downsides, and the better ETF will greatly depend on individual circumstances and preferences. Remember, the better ETF depends greatly on your individual investment goals and risk tolerance. We hope this deep dive into SCHD and JEPQ has given you some food for thought for your investment strategy. We've taken a comprehensive look at these two ETFs, breaking down their characteristics, management fees, and yields. Starting with SCHD, it's a well-established ETF with a reputation for consistency and reliability. It's a dividend ETF, meaning it focuses on companies that consistently pay out dividends, which can be an attractive feature for those looking for regular income from their investments. Then we have JEPQ, a newer player in the game, but one that is showing some serious promise. JEPQ focuses on companies in the emerging markets, offering potentially higher returns, but also bringing a higher level of risk. In terms of management fees, SCHD has a slight edge with a lower fee, making it a more cost-effective choice for those concerned about the impact of fees on their overall returns. When it comes to yields, the picture is a bit more complicated. SCHD has a strong track record of stable yields, while JEPQ's yields can fluctuate more due to the nature of the markets it invests in. It's important to remember, though, that investing is not a one-size-fits-all endeavor. What works for one investor may not work for another. It's crucial to do your own research. Consider your personal financial situation and investment goals, and if possible, consult with a financial advisor before making any investment decisions. This video is just a starting point, a way to get you thinking about the different factors that can impact your investment strategy. There's always more to learn and explore, and we encourage you to continue your investment education journey. If you found this video helpful, don't forget to subscribe, like, and share it with fellow investors. Thank you for watching.